Hello, everyone, and thank you very much for joining us today for our capital markets webinar, preparing your listed company for the 25-26 financial reporting season. My name is Joseph Archer, and I'm a partner here at PKF Littlejohn. Before I introduce our speakers, I just want to make sure we cover off a few housekeeping points. Firstly, if you have any questions during the webinar, you can submit them through the Q&A widget at the bottom of the screen. We will try to answer as many of these at the end of the webinar, but if your question needs a fuller answer or we run out of time, we will get back to you later via email. Please do note we capture all of the questions and we do respond. Also, there will be an online on-demand version of the webinar will be available shortly, and we will circulate the recording as well via email, so you will have access to it at a later stage. The webinar is designed to help ensure that company finance teams are aware of the 25-26 year-end reporting environment, its impact on their company, and the steps to prepare and review their annual report to make sure that they comply. Our speakers will be discussing the common disclosures and accounting errors picked up by the FRC, corporate governance requirements impacting large and listed companies, the ever-evolving landscape relating to AI governance, and the accounting implications of digital asset treasury policies. Now on to our speakers. Firstly, we have Callum. Callum McChrystal is a manager in our corporate and capital markets team. He has a vast experience with clients ranging from privately owned businesses to large listed multinational groups. Many of his clients are international businesses and his extensive insight into the challenges and opportunities involved in those audits. Jessica Wills is a partner and head of governance, risk and control assurance. Jess has a wealth of knowledge of best practice governance, risk management, and internal controls built up over the last 23 years. Her work includes assessment of governance frameworks and board effectiveness reviews across financial services and corporate clients. She closely monitors corporate governance developments and best practices, with a particular focus on Provision 29 of the UK Corporate Governance Code at the current time. Jess also leads a team of environmental, social, and governance and sustainability specialists providing reporting and assurance services to a wide range of clients. Phil Baldry is a partner and head of technology at PKF with over 30 years of IT experience across a variety of sectors. He specialises in working with PKF audit teams in London to deliver projects with complex integrations and large data volumes with automation and data analytics support. Phil has worked with many clients and suppliers on the implementation and management of policy and procedures to maintain the required high standards. And finally on to Nick. Nick Joel is a partner in our corporate and capital markets team. He specialises in large and complex audits and works with listed companies across all UK markets and many overseas ones, including the TSX and NASDAQ. Nick's industry knowledge spans a wide range of sectors, including cryptocurrencies, oil and gas, natural resources, and manufacturing. Please remember to submit your questions to our panelists. And now I'll hand over to Callum to begin.
Thank you, Joseph, for the introduction there, and good morning to everyone. As outlined in the agenda, the Financial Reporting Council have released their annual review of corporate reporting as part of the 2024-25 monitoring cycle. This report sets out the areas where the FRC most frequently challenge companies. It draws out best practices on how to avoid these common areas of challenge, and it also gives headline expectations for the coming reporting season for 25-26. Alongside the issuance of the annual review of corporate reporting, the FRC has issued two thematic reviews designed to enhance the quality of and to provide insights into UK company reporting in respect of investment companies and also share-based payment arrangements. Both of these are available through the FRC's website. Regarding structure for my section of the webinar, we're going to be running briefly through the key takeaways from the FRC's review before having a more in-depth analysis of the common findings from the FRC's substantive questions, with us then finishing on the expectations for the next reporting cycle. Now, while the objective of the FRC's report is to uphold high standards of corporate reporting, which are crucial for maintaining both investor confidence and supporting UK companies' access to capital, there were marked notes of improvement within the reporting cycle and the maintenance of quality, especially in the FTSE 350 companies reviewed. The corporate reporting review team actually found a lower proportion of reviews resulted in queries being raised with companies compared to previous years, with overall restatements prompted by the reviews falling compared to the previous 3 years. For the third consecutive year, impairment of assets was the issue most frequently raised with companies, which was accounting for about 10% of all the cases raised, although no companies were required to restate their accounts for impairment matters. Cash flow statements, an inconsistency of information between financial statements and other sections of the annual report and accounts, continue to present challenges. Moreover, there does remain a quality gap in reporting between companies in the FTSE 350 and other companies, with the majority of restatements continuing to arise in companies outside the FTSE 350. Thank you, Rosie. So in terms of the FRC's findings at a glance, the table on this slide represents the top 10 topics on which the FRC raised substantive queries, with them being ranked accordingly in order of the number of companies involved for each. As noted on the right-hand side there of the table, items denoted with an exclamation mark indicate that these required companies to restate their financial statements as a result of the queries raised. We're now going to run through each of these topics highlighted and pull out the key findings and how you as companies can ensure adherence to the financial reporting frameworks. So starting with the impairment of assets, the review of impairment of assets identified several compliance and disclosure issues in impairment testing. Key findings included inconsistencies between assumptions used in impairment models and those then disclosed in other areas of the annual report, such as in the viability statement. The erroneous inclusion of cash flows from enhancements of assets in value and use calculations, despite the guidance within IAS 36 explicitly prohibiting this. And then generally a lack of clarity in disclosures with regard to the determination of cash generating units. Interestingly, reading and reviewing the FRC's findings section, many of these queries noted here could have been captured by clearer and more concise impairment disclosures on inputs and assumptions, or then better linkage between disclosures on impairment and other areas of the annual report. Cash flow statements continue to be one of the most common reasons for companies making a prior year restatement as a result of the FRC inquiries, although this number did fall compared to the 2023-24 reporting cycle. The majority of the FRC's questions concern the classification of several material cash flows, and this is something you really need to be careful on, as misclassification can be done very easily. However, within IAS 7, it does give indicative examples that you can refer to, or naturally, as your auditors, we can provide assistance where there are queries on the classification of cash flows. Additionally, there were many instances of what you would, sorry, Rosie, of what you would consider non-complex errors, such as operating activities not being adjusted for all non-cash transactions that had occurred, or the inclusion of non-cash transactions and movements in investing and financing activities sections, where items there should obviously be strictly true cash movements. To ensure compliance with IAS 7, companies need to ensure the classification of cash flows are in line with the criteria discussed in the standard, amounts are not being netted off inappropriately, and then amounts and descriptions are consistent throughout the financial statements. Thank you. Unsurprisingly, the financial instruments remains high in respect of substantive queries being raised by the FRC, given the complexity of both IAS 32 and IFRS 9, and then the nature of some of the transactions getting captured within that, so expected credit losses, derivative contracts, and hedging arrangements. All restatements noted were as a result of inappropriate application of offsetting arrangements for financial instruments. And just as a reminder on offsetting, it's only permitted when the entity has both a legally enforceable right to set off recognized amounts and also that it intends to settle on a net basis or simultaneously. A further common finding pertains to a lack of detail in disclosures over expected credit losses, which may not be relevant to all attendees on this webinar this morning. However, the omission of relevant disclosures altogether or circuitous accounting policies that did not set out how transactions were in the scope of IFRS 9 were also noted, which are probably more generally applicable. To alleviate these, companies should look to ensure that sufficient information is provided in disclosures over financial instruments, including the nature and risks, and that any inputs and assumptions on expected credit loss calculations are then appropriate. In terms of the presentation of financial statements and related disclosures, a lower volume of queries here was raised, but the instances of restatements then went up. Key findings here to draw out included inconsistencies in the classification of amounts due from group undertakings between current and non-current, omission of accounting policies on material transactions or amounts, and inadequate disclosures on complex or unusual transactions and their nature, like some of the financial instruments we discussed just on the previous slide there. It's essential that disclosures in the financial statements contain sufficient information to allow users to understand both technical and complex transactions, and that accounting policies are present for all material items. Thank you. With revenue having been considered in a prior thematic review, predictably, substantive queries over revenue for the 2024-25 review cycle did reduce significantly. Similar to some of the other topics we've already covered on the slides previously, queries related to clarity of related accounting policies and also significant judgment disclosures. Specific points that can be drawn out in the report included rationale over revenue recognition and measurement of satisfaction of performance obligations, how the transaction price was determined, and then finally, inadequate consideration of principal versus agent. Sufficient information needs to be provided for users of the financial statements on all revenue streams, and judgments made in relation to the recognition of revenue need to be sufficiently detailed. On the Strategic Report and Companies Act, fewer queries were flagged by the FRC when compared to the 23-24 Corporate Reporting Review. Significant questions related mainly to the lawfulness of dividends and general compliance with the requirements over distributable profits and the timing of distributions. It's vital that the strategic report provides a fair, balanced, and then comprehensive review of developments, and that the necessary requirements over the payments of dividends are being adhered to. Thank you. On judgments and estimates, providing high quality disclosures in this area continues to be a key finding from the FRC. Given the ever-evolving geopolitical and economic climates, such disclosures are necessary to enable users to appreciate the effects of these uncertainties on the financial statements. Wider challenges from the FRC arose over the disclosures on estimation uncertainty, lacking key detail on key assumptions and sensitivities, and instances where other information presented in the annual report implied the existence of a significant judgment having been made, but then there was no corresponding disclosure actually being included in the annual report. Companies should ensure that all judgments and estimates are described in sufficient detail, disclosures on key sources of estimation are discernible from other estimates, and that disclosures over significant estimates contain the requisite detail. The presentation and calculation of deferred tax, along with its recoverability, remained safely within one of the top 10 topics. The FRC had specific queries over the recognition of deferred tax assets as a result of trading losses, despite a lack of evidence thereon. The recognition of deferred tax assets on share-based payment deductions without any apparent consideration of the timing of exercise of those options, alongside then the forecast taxable profits. Other matters noted concern frequent inconsistencies between information in the taxation reconciliation note and other disclosures in the financial statements. In preparation of the financial statements, the disclosures under IAS 12 need to be informative and transparent and must contain sufficient information and supporting evidence as to the recognition and then ultimately the recoverability of any deferred tax assets that are getting recognized on the balance sheet. Consolidated financial statements has appeared in the top 10 topics for the first time in recent years. The key element, here is really being able to adequately demonstrate and document control. Challenges from the FRC related to inconsistencies between significant judgments, disclosures on control, and disclosures in other areas of the financial statements. Uncertainties over the application of IFRS 10 in instances of complex or unusual transactions, and a lack of clarity over the accounting treatment in scenarios where the parent company's ownership in a subsidiary changed, but did not result in a loss of control. To ensure compliance with IFRS 10, companies need to disclose all factors considered in assessing whether an investor controls an investee and the significant judgments applied in making that assessment. As companies have become more familiar with reporting in accordance with these frameworks, fewer substantive queries have been raised year on year in respect of climate-related narrative reporting. Questions from the FRC covered where companies had failed to provide qualitative or quantitative analysis in their business model, erroneous applications of the small companies exemption from presenting a strategic report, which would have then included CFD disclosures, and then inconsistent reporting on greenhouse gas emissions across the annual report. Companies need to ensure that disclosures are clear, concise, and specific to the entity. They need to also disclose the material impact of climate change in the financial statements and ensure consistency between climate-related disclosures and other disclosures in the annual report. Thank you. And finally, then for my section, just touching on the FRC's expectations, it's worth drawing out that the financial reporting framework in the UK is principles-based and does require the application of judgment. Preparers of financial statements need to be considering these requirements in determining which information requires disclosure in their annual report and accounts. It's also important to highlight that the FRC do not expect companies to go beyond what is necessary to comply with these requirements. Good quality reporting does not necessarily require a greater volume of disclosure, and the findings and commentary from the FRC within their report reflects this underlying assumption. The report notes that many of the common areas of challenge could have been identified through a sufficiently robust pre-issuance review process, emphasizing that this does remain a key expectation for companies' oversight processes. The final two elements of this slide highlight consistent improvement points raised across the 10 topics, being disclosures over judgments and estimates needing to be clearer and sufficiently detailed, and then narrative reporting in the strategic report needs to present a fair, balanced, and comprehensive review of the company's position. I'm now going to hand over to Jess, who will run you through an overview of the UK corporate governance landscape.
Great, thanks, Callum. So good morning, everyone. I'm Jess Wills. I'm a partner and head of the Governance Risk and Control Assurance team here at PKF. And I'm going to provide an update in this next session on UK corporate governance landscape, latest developments, and also what's coming down the line. And firstly, it's important to say that corporate governance remains a key priority for regulators, but perhaps even more so for wider stakeholders and society. And I guess just reflecting on recent news, corporate governance at the BBC is clearly under some public scrutiny at the moment, with not only resignations by senior figures, but also sort of concerns around the operation of the board and its responsibility for oversight and strategy. And that clearly has a knock-on effect of the reputation of the BBC and is very much another reminder that organisations really can't afford to have corporate governance failings. So in the UK, we have 3 corporate governance codes relevant to large and listed companies. Firstly, for large privates, there's the weights principles. For AIM listed companies, we have the QCA code. And of course, for full listed companies, there's the UK Corporate Governance Code, which is also considered best practice standard that other companies may strive to achieve. I'm not going to cover each of those in detail. The key features and differences are set out on the slide, but there are some common threads that, of course, run through them. Firstly, all are based on principles, with the UK Corporate Governance Code being perhaps the most prescriptive with a set of provisions. All seek to achieve transparency, accountability, and stakeholder trust by requiring companies to disclose and explain how those principles have been applied, and all have a strong focus on purpose, leadership, culture, and of course, the support of long-term success. So that's the current position, and how have we got here? Well, it's hard to talk about corporate governance without mentioning the Carillion collapse in 2018, which of course triggered a whole set of public debate and inquiries, and ultimately led to the government white paper on restoring trust in audit and corporate governance in 2021. And while some of the proposed reforms in that paper have moved forward, others have dropped away or been delayed, either due to concerns around the cost to UK business, but of course the recent changes in government and priorities as well. However, we have seen in those recent years on the timeline updates to both the QCA code and, of course, the UK Corporate Governance Code. So firstly, on the QCA code, this is designed for AIM and other small and mid-cap quoted companies. It's now in its third edition, with the QCA seeking to move the code forward, considering wider stakeholder needs and latest good practice. I've listed the key changes there on the slide, with some of the key points being around Principle 4 and the taking account of wider stakeholder interests, such as workforce, but also corporation and consideration of environmental factors in the company strategy, risk management, and business models. There's increased focus on board independence, composition, and succession planning, and within that, consideration of skills, experience, and capabilities. And then there's a new principle regarding remuneration, covering remuneration policy and pay structures aligning to shareholder value. For the main UK Corporate Governance Code, we were actually expecting quite a raft of changes based on the consultation that was put out by the FRC, but in the end, changes were very much kept to a minimum for the reasons stated there in the quote from the FRC Chief Executive. Again, listed the key changes on the slide there, with the key points being around emphasis on culture and the board to assess and monitor how the desired culture of the company is embedded. Sharper focus on workforce and stakeholder views and how those inform board decisions. And similar to the QCA code, a strengthening of remuneration requirements, but in this case, the focus being on the malus and clawback arrangements and the disclosures around those. But of course, the main update and what's been the most significant thing of the UK Corporate Governance Code update has been in relation to internal controls and the Audit Committee and Board oversight of controls and the framework, and specifically the new requirements for Provision 29. So what is Provision 29? Well, this is for listed companies in the scope of the UK Corporate Governance Code, and Provision 29 requires a board declaration in the annual report on the effectiveness of material controls at the balance sheet date. There are three elements to that declaration. Firstly, disclosures on how the board monitors the internal control framework, and that's not just financial controls, it's a broader set of controls across operational, reporting, compliance, and so on. Secondly, the board has to declare the effectiveness of material controls at the balance sheet date, and also any details of material controls that have not operated effectively and the actions that have been taken around those. Whilst the UK Corporate Governance Code latest version came into effect on the 1st of January 2025, this Provision 29 kicks in January 2026. So it's very critical in terms of getting ready for this over the course of the coming year. Key points to note, which the FRC has been keen to emphasise, and a lot of public discussion around this, but they're very keen to emphasise it does not introduce a UK SOX regime. There is no external audit or external assurance requirement around material controls, and it's very much for each company and board to determine what their material controls are and what assurance they want over them. Whilst Provision 29 may, on the face of it, sound straightforward, there is a lot for boards to consider. This slide sets out some of the key questions that I think boards should be asking themselves. Firstly, the first two boxes, materiality and scope. These are very much the start of the process as you start to think about Provision 29, and they are really important to getting it right. It's very important there's a clear understanding within the company and at the board level around what material controls are, the definition of that and what they are for your organisation. And secondly, ensuring that the scope of those material controls is adequate, that it does cover all those areas that I mentioned earlier: financial, operational, reporting, and compliance. So once you've identified that sort of population of material controls, it's then thinking about what monitoring and review processes are in place to assess their effectiveness. And for some companies, they won't necessarily need to reinvent the wheel on this. You may already have strong risk management processes or regular testing of risks and controls. But other companies may need to be thinking about introducing this more formally or enhancing what they already have. Make sure there is that adequate monitoring, review, and oversight of how material controls are operating. For me, the purple box here on the slide, assurance, is one that speaks to my heart, given I lead out our internal audit services to clients. And here, this is about thinking what assurance your company has around material controls. And the FRC has very much encouraged boards to think about what assurance already exists within your company. And to think about that across the three lines. So your first line, your second line risk and compliance functions, and of course the assurance that you get from your internal audit function as well. This may give you really strong coverage, but alternatively, it may help you to identify gaps where you need to think about getting additional assurance, and then you can think about whether that's going to come from internally or whether you may need some external support to cover those off. In terms of actually making the declaration, this will clearly require some careful thought around those disclosures, particularly if you are in a position where you're reporting on material control failings. Need to think about how you present and pitch that. But of course, the principles of being accurate and transparent in making those disclosures is going to be critical. And then finally, provision 29 may require you to have a bit of a rethink and a refresh around your governance and oversight arrangements, thinking about the board and the various committees that have responsibility for overseeing internal controls and becoming really clear on where those roles and responsibilities sit. You may need to think about what additional information needs to be presented to the board and the committees to really enable them to have that oversight of material controls and their performance. And then finally, thinking about reporting trends around corporate governance. This is very much hot off the press. The FRC published their annual review of corporate governance reporting earlier this month. It's a lengthy 51-page report, so you'll be grateful to hear that I've just got the one slide on this, and I will leave it for you to read that report. But the headline messages are set out here. In terms of positives, the FRC very much feels that reporting is becoming clearer and more transparent in some of those key areas around company purpose and so on. They're seeing that desired movement towards more outcomes-based reporting and focusing on the actions of the board and the impact that has. And they were also pleased to see evidence of preparation for provision 29 in the latest disclosures as well. On the areas for improvement, some of these items are consistent with prior themes around being more concise in disclosures, avoiding boilerplate disclosures, and so on. Probably ones here that I'd look to call out is the second bullet point around focus on the board. So if the board isn't involved in things, then you don't need to be reporting on that. Make sure your disclosures are very much focused on the things that your board has been involved in and is making an impact on. The fifth bullet is around avoiding duplication, and we do see this quite often where there's duplication in annual reports on key areas like stakeholder engagement or risk management. And really encouraging companies to look at how that information can be consolidated or otherwise making better use of cross-referencing rather than repeating. And then finally, I think this is a good shout, minimizing the sort of simple repetition of regulatory requirements and language from the UK Corporate Governance Code, rather than just sort of relaying the principles and provisions of the code. Really focus your disclosures on how those principles are applied within your company. So final thoughts and sort of sum up from me. As I said at the beginning, corporate governance remains that key priority. Keep this front of mind, have a clear understanding of what's important to your stakeholders. Secondly, keep those corporate governance arrangements under regular review, whether that's through internal assessments or external reviews. Companies change and stakeholder interests evolve. So it's very important that your corporate governance arrangements don't stand still. Thirdly, look to continually enhance and improve on your corporate governance disclosures. It's very much an opportunity for you to tell the story of how your company is governed and managed and the impact that has. Of course, those disclosures should be outcome focused and aligned to stakeholder interests, and definitely consider the good practices set out in that latest FRC report. And then finally, if you're in scope provision 29, do start or move forward your preparations. I don't think it's too late, but of course, as I said earlier, there is a lot to consider and do. And do talk to us if you need help with that. So I'm now going to hand over to Phil.
Many thanks, Jess. So moving on from corporate governance, I wanted to explore AI governance and the role it plays in adoption and realizing the benefits of AI. So I'm Phil Broadberry. I lead the technology division within PKF. And this morning I'd like to share some thoughts on what we've seen in terms of AI adoption within financial teams, what AI governance looks like in reality, and importantly, how AI governance can be a platform for innovation. If we start with the general landscape. So the EU AI Act provides a very helpful definition for us. Rather than confusing AI with traditional technology, the focus moves to systems that operate with a level of autonomy, that they may adapt after deployment, and inferring results from input rather than calculations. I believe this really helps to focus on those services that meet the definition rather than just new features or traditional automations, particularly when it comes to classifying your use of AI systems. But in 2022, the game certainly changed. Generative AI was really spearheaded by ChatGPT, which introduced the natural language processing of input and human-like responses and conversations. We're seeing generative AI capabilities performing particularly in an assistant role, so aiding everyday tasks. Where AI services become more powerful, though, is when they're embedded within workflows or automations. So traditional workflows run through a series of logical steps, but when we embed generative AI into them to reason over inputs and change processing based on inferred decisions, this can really turbocharge your automation journey. We always recommend keeping a close eye on your vendor roadmaps, understand what's coming, and what they're using to protect your data. But agentic AI is what's really getting the limelight. This is AI agents that start automatically, that complete transactions with little or no human interaction, and engage with other agents and processes. However, we've not seen that many practical implementations of this yet, but that's highly likely to change as we move into 2026. So if we move on to thinking about Microsoft's toolset for a moment. As the BBC would say, there's other AI providers are available, but our questions tend to be focused on the Microsoft environment. So let's start off with prompts. So Copilot Chat, or if you've got the additional license, the Copilot M365 system is our core interface for prompts. And the little green shield at the top right hand of the screen identifies that enterprise data protection is on. These can be shared through prompt galleries within teams for team members to use or promote them to agents. Now, within that Copilot interface, we can pre-save prompts that only the owner can change. These are often called the light versions of agents with limited configuration. So as we move on, we get into Copilot Studio. Copilot Studio is much more structured delivery development environment aimed primarily at our users. And this provides environments for us to set up, build, test live environments and take agents through a structured journey. Additional data sources can be defined, and you can control who has what access to which data source. And finally, Foundry. This is the professional development environment, really an engineering tool set for professional developers to use and build out full-scale applications. And as prompts and the use of LLMs gets more embedded into automations, that's when we get much closer to that agentic AI era. So some prompt use cases that we have seen or discussed with financial teams. I won't go through all of these, but just as a summary on contracts. So extracting out and summarizing financial clauses, payment terms, and risk factors from contracts. And on impairment triggers, we're scanning news, reports, and databases to identify relevant external risks. Also have use in scenario planning, so automatically building out financial models based on maybe commodity price shifts. And understanding investor sentiment, so analyzing news, social media, and analyst commentary to dive into that wealth of information and provide you with a starter report. So in practice, we very much see these as aids or assistants to tasks, where professionals use the output to enhance their deliverables, improve their thinking, or get a quick start or a draft to a document. So some prompting basics. There's lots of acronyms and approaches in this area, but if we just start by having a look at the basics. So generally speaking, better prompts return better results, just like better questions result in better answers. Think about the role you want your system to perform and the knowledge they should have. Be clear about that in your prompt introduction. Specify the actual task and clarity around the actual output format that you need. Provide clear context and any constraints you want it to consider. Avoid being vague. This can lead to more hallucinations. And avoid asking for too much at once and forgetting your core purpose. Do use your tool of choice to refine the prompt and optimize it in the required area, or indeed ask it for suggestions to improve that prompt aimed at a particular task. So an example of this, simple example, asking for factors that might trigger asset impairment on a project and create a simple risk matrix. In this case, I'm using the regular Copilot chat service, and the output from this prompt is a matrix. Personally, I quite like using a scoring mechanism of 1 to 10 and give it some guidance on what 1 to 10 means. But in this case, I've let the model decide for me, and I've got a high, medium, low, and a critical classification. Please note the suggested next steps down the bottom of the screen below the matrix. In this case, it's suggesting create a heat map or create an explanation on how volatility affects impairment. The point here is really it's prompting you to have a conversation and further that prompt. But for now, what I've asked for next is an explanation of the risks that it's identified. I wasn't particularly clear in this prompt, so I'm given the top 3 risks Copilot's identified with some explanatory text, which may be helpful. Now let's assume it is helpful. I've then gone on to ask for suggested controls I might implement to monitor those risks on the next slide. So now I've got some suggested controls, some data sources, things I might want to look out for. As mentioned, note the suggested actions. So at the bottom of the screen there, you can see create a table or a dashboard for KPIs, or maybe add thresholds I might want to consider. And hopefully this shows how you can use Copilot or your favorite interface in a conversational way to assist you in a task. And prompting certainly is a great assistant. Just talked about disclosures and running your disclosures through guidance and identifying potential gaps. But in these scenarios, I'd heavily focus on it being an aid to help you or speed up a process. Where things get really interesting, though, from a business efficiency perspective, is saving useful prompts as agents and embedding LLM prompts into workflows. But for that, we really are going to start needing to think about governance to manage change in a responsible manner. So if we start off with the high bar in AI governance, ISO 42001. So this was launched in December 23, and the standard includes about 40 controls split into these categories. You might need to seek accreditation to satisfy stakeholders, regulators, or clients, or you might choose to cherry pick some of these controls to take steps into AI governance to suit your specific needs. To give you a flavor of those controls, I've put on the next slide the controls related to AI policy. When seeking accreditation, you'd need to evidence each of these controls and show them in operation. So we need to have a clear AI policy which aligns to other policies, GDPR being an obvious one, and ensure that these are reviewed at agreed intervals. Auditors would look for evidence of these and the suitability of that policy for your organization. But what we see in practice is a variation on this, which might be a good start and get on a journey to ISO or another standard. So typically steering groups are formed to turn your strategic intent into clear policy, the communication of that policy, and address key aspects such as ethical use and mitigating the threat of bias. But culture for me is really key. And I believe this involves from clarity and purpose, training, transparency about use, and also transparency about the impact that these services are having. Steering groups would typically agree projects and really importantly, set up frameworks for feedback, leading to continuous improvement and clear visibility of actual benefits that are being delivered. Let's take a look at a few of the common risks that steering groups would need to be aware of and develop their mitigations to suit the organization. Importantly, your supply chain embraces AI. You need to be aware of where those are being used and ensure you know where your data is being processed and how that's being protected. Ensure human viewpoints are and expectations are clear. You'll hear human in the loop as a phrase quite often, whether that be to validate before committing to a transaction or spot checking workflow runtime. Your steering group will help mitigate these risks through their policy, awareness training, and review of usage. Not on the screen is the emerging term of work slop or sloppy work. We can avoid this by clear training, clear expectations, and clear policy on communicating where you're using AI services. So in summary, AI is certainly with us, and embracing it in some shape or form has potential for huge personal productivity gains and transformation of business process. Poor data quality and low trust is a huge barrier. So we need to set realistic expectations, solve root causes of data quality. Governance really can be a great enabler, as well as likely a future regulatory requirement. Getting best practice in place should set you up really well. Understand your tools that you're using, ensure you've got strong data protection, and use trusted data sources to train your agents. We're seeing some really great things coming from the major tech vendors. So, for example, expect to see agents that can use your applications and websites without training and perform transactions for you just from a prompt, likely to be seen in fairly early 2026. I'm aware that we've got some clients on the call, and where we provide audit services, we may have ethical conflicts in assisting in AI projects, but we're very happy to have a chat, so feel free to reach out. So I just wanted to finish with where we can help. We have been involved in review of existing policies and governance frameworks and identify gaps and areas for improvement. We'll be delighted to talk about art of the possible workshops and identify priority projects. The outsourced AI officer role, that's effectively a facilitator to get your steering group set up, define terms, policy, awareness sessions, and put in place those really important feedback loops for continuous improvements. The assessment of vendors, including AI providers, may need support. That's really to ensure you're evaluating the risk and fully understand your data processing. Thank you for your time this morning. I look forward to any follow-up conversations and questions, and we'll now hand over to Nick Joel.
Perfect. Thank you very much for that, Phil. So just as a quick introduction, and as Joseph mentioned at the start, I'm Nick. I'm one of the audit partners here in our capital markets team, and I look after a number of the firm's clients which incorporate digital assets. So be that a cryptocurrency miner, an investor, or what our key focus here is those either which already have or are looking to implement a digital asset policy. So before we get into what a digital asset treasury policy is, I thought it would be useful firstly to give a summary of what digital assets actually are and some of the key terminology that you hear there in the day-to-day world of crypto. So it's useful to know the full scale of the definition and what it incorporates, not just from a risk mitigation perspective, but also for your communication requirements with different stakeholders there as well. Probably the most commonly known digital asset that we've all heard of is Bitcoin. That probably is the most commonly used cryptocurrency within the treasury policies at the moment that we've seen. But the wider definition of digital assets are much more broad than just Bitcoin, really. So what actually is the definition? A digital asset can be defined as intangible assets that are created, stored, and transferred electronically, typically using distributed ledger technology. And what that is the blockchain itself. Different examples outside of Bitcoin. So Bitcoin is a cryptocurrency. There are other cryptocurrencies also that potentially people have heard of and ones to consider really as part of your treasury policy. So things like Ethereum, Solana, Polkadot, for example, operated on slightly different blockchains from Bitcoin. You've got stable coins and central bank digital currencies. So things like your USDT or USDC, they're pegged to the US dollar, for example. Non-fungible tokens or NFTs. And again, something that's sort of more up and coming now is a digital representation of your traditional assets. So things like digital gold tokens or carbon credits, for example. The key characteristics of a digital asset, so they exist only in digital form. There is no physical counterpart, although there is a representation in a way of those traditional assets, as I mentioned. The token itself is in digital form. They are cryptographically secured, so the ownership there is verified by private keys. It's not done, for example, in your bank accounts, which are held through the ledger holders, which are the banks. And the same with the transfers there as well. The transfers between parties are done by the blockchain networks and not by those ledger holders. So there's a decentralized ownership record there as well. And probably the final key characteristic there is the volatility itself. I think everyone's aware of the volatility of Bitcoin and other cryptocurrencies tend to follow the value of Bitcoin. And for example, in the last day alone, Bitcoin's increased from around 65k to 70k. So moving £5,000 in one day is quite significant volatility. And what you need to be aware of and what you need to consider as part of your treasury policy is how to mitigate and hedge against that risk. The purpose of digital assets. So there are a variety of reasons for the implementation of digital assets, and they've actually developed over time as blockchain technology also develops. The purpose of different types of assets also vary based on which asset you hold on those examples that I went through. But originally, cryptocurrencies were developed to act as digital money, and with the idea of eventually becoming a medium of exchange. So the purpose was to remove that middleman, i.e. the bank, acting as a ledger holder, and allow transactions to be made from a peer-to-peer basis there. NFTs were developed to represent either real work or digital ownership, and the blockchain allows you to prove authenticity and ownership of those NFTs. But overall, the idea was to develop transparency, to digitize and secure information to enable storing and the transfer of value effectively and efficiently. But probably what we've seen more so at the moment is not really following those lines. People are seeing Bitcoin and other cryptocurrencies more of a commodity in a way, which can represent significant upside in their investments and therefore the increased trend in people setting up these treasury policies. But what is blockchain technology? So it may not be necessary to fully understand what blockchain technology is if you're just looking to implement a asset treasury policy. But understanding the basics of the ecosystem, how it's built, can enable your decision making in terms of to develop that policy and what digital asset that you actually choose within that policy as well. So blockchain itself is a digital ledger that records transactions in a way that's secure, transparent, and tamper-proof. So unlike your traditional databases, it's decentralized, meaning no one single party controls data. And really what makes blockchain attractive for financial applications is the decentralization there, the immutability, the transparency, and the ability to work with smart contracts on the blockchain. The final 2 points I got on this slide here is custodianship and staking. So two things you probably hear coming into the digital asset world there as well. So what is custodianship? Custodianship really is the safeguarding and management of your digital assets, usually on behalf of your company or an individual. And that's undertaken by third-party custodians usually, so people like a Gemini or a Coinbase, for example. They provide the secure storage, the transaction facilitation, the compliance oversight for the recording and storing of your digital assets. They're often regulated entities as well, or they have controls audits carried out on them. So it gives companies greater security and comfort in respect of the storage of your assets there as well. Companies that do self-custody, there potentially is high risk there from an operational and regulatory perspective. So again, something to consider as part of your treasury policy if you're looking to implement that. And finally, potentially something a bit new for some people is staking or staking rewards. So staking itself is the process of locking up your cryptocurrencies to support the relevant blockchain network operations usually for liquidity purposes. So the participants will earn rewards for securing that network in the form of a staking reward. So quite similar to bank interest, for example. So where your money's held in your normal bank account, you earn interest there. Same thing here. So you'll lock up your cryptocurrencies for a period of time and you'll earn rewards on that there as well. So the next slide is just really the components of a treasury policy itself. I've pulled out 5 key elements here. So the first one really being governance. So looking at the board of management and oversight, so relevant approvals of your transactions, for example, approval thresholds you should look to include within there, and segregation of duties. So that's whether it's a self-custody or a third-party custodian wallet. You should look to include strict and clear guidelines around the governance policy within there. The investment and liquidity parameters. So the purpose of the holdings, is this just strategic or is that transactional? In respect of the policies we see at the moment, they're mainly strategic. However, there's probably a move towards a transactional purpose in the way of that staking, as mentioned. So a move away from holding just Bitcoin in your treasury policy to a proof of stake network like a Solana, like an Ethereum, where you can earn those rewards there as well. So I guess a clear policy needs to be put in place around the investment strategy and the liquidity parameters in there. So looking at also the exposure limits that you have between balancing your fiat cash, i.e. what's in your bank account, to what's going into your crypto holdings. The third point is the custody and security. So again, if you're looking to use a third-party custodian, which is potentially more secure, but if you're looking to self-custody, what are your wallet management controls? Do you have two-factor authentication, for example? Have you done due diligence on where that's being held? The fourth point is accounting and financial reporting. So we've got a brief slide later on just to give you an outline of the accounting requirements and the fair value requirements that's there as well. But probably setting a clear policy on how you're valuing or what website you're looking at to value your digital assets, be it a CoinGecko, for example, or CoinMarketCap. And finally, risk management. As mentioned before as well, the volatility in the digital asset world is quite significant. So what risk management procedures do you have in place to make sure that the exposure isn't too significant or you're hedging against those risks? And it's not just a volatility point of view, it's an operational, also cyber point of view, and also your reputational risks there as well. And the next slide, I've got a quick overview of why so many people are adopting at the moment. The first point is appealing to tax-savvy investors. As your investors have developed over time, holding Bitcoin actually can attract a new class of investors to your business when this is something you haven't quite experienced before. So there are people that value digital assets, they value innovation, and they can be attracted to your company once you delve into this world of cryptocurrencies and digital assets. Companies that have adopted treasury policies often do this to modernize their financial image and broaden that investor appeal there. There's significant strategic financial upside. So companies who have adopted such a policy at the moment regularly trade at a significant premium to their treasury value, reflecting that investor sentiment for exposure to crypto on traditional markets and the ability of publicly traded to access those markets as well. There's also that ability also to generate additional inflows through that staking rewards I mentioned earlier also. Hedging against inflation. So Bitcoin, for example, has a fixed supply of 21 million coins to be processed on that blockchain, therefore reduces the risk there of inflation as well. It makes it a hedge in its own way, albeit at the moment there's still significant volatility in the market there as well. And finally, liquidity. So Bitcoin, for example, again offers a 24/7 liquidity, digital portability, making it a bit more flexible than your traditional assets like your golds or bonds, for example. On regulation, the regulatory environment surrounding crypto assets is continuously evolving, and it is quite difficult to keep pace with new technologies in the crypto space. So things like your decentralized finance, your initial public coin offerings, crypto derivatives, for example. So there are different regulators, but no set real clear regulation at the moment. The FCA itself hasn't released any regulatory framework in respect to treasuries, but they have published a crypto roadmap which has discussion papers and draft documents, which a full regime is expected to go live in 2026. So at the moment, it's just a watch this space. The Aquis market have released formal framework for issuers pursuing cryptocurrency strategies, which was effective from the 1st of September 2025. And the idea of that framework was to ensure market integrity and appropriate investor disclosure. So ensuring that you have disclosed that treasury policy, what we've outlined on the previous slides, define and disclose the valuation methodology, the performance of the holdings, but also the risk statement as well. So your shareholders and stakeholders are aware of the risks of your treasury policy. And finally, probably a bit more guidance is just on the NASDAQ side, so on the US markets, where there's probably a bit more uptake than the UK markets at the moment. There is a cryptocurrency regulation guide for NASDAQ, so that formalizes and legitimizes crypto treasury strategies rather than looking to restrict them, focusing again on that investor transparency and board governance. So if you're looking to implement one, I'd probably recommend having a look at the guidance released by NASDAQ, because that's probably going to be a similar roadmap to what the UK regulators are going to follow as well. A quick overview of the accounting and disclosure requirements. So there is no set standard at present for crypto assets, but guidance has been released from the Interpretations Committee back in 2019, also from the US GAAP perspective from the FASB as well in 2024. And really, it's there on screen. You're looking to hold that at fair value. From an IFRS point of view, that will be fair value for OCI. So any gains will go through OCI, and any decreases or impairments will first offset that OCI balance and then pass through the P&L as an impairment. From a disclosure point of view, they're just looking for your clear and concise treasury policies to be included, a specific accounting policy, the valuation methodology, and the disclosure of the significant estimates and judgments involved. So really just trying to promote that true and fair view in the financial statements. US GAAP is slightly different, so it's just fair value through P&L. If anyone has always looking to adopt US GAAP or move into the US markets, everything goes through the P&L there rather than through OCI, as it does from an IFRS perspective. On the next slide, just a very quick overview of what we're looking for from an audit point of view. So we're looking at evidence of access to your wallets, the controls surrounding that. If you're using a custodian, we should be able to get a year-end statement of the holdings to confirm the completeness and accuracy there. Any supporting documents for your fiat to crypto, so from the cash to crypto balances, bank statements, and then wallet transactions there as well. Crypto settlements in terms of your expenses or salaries, for example, being paid directly in cryptocurrencies. Breakdown of your transactions, the basis for your valuations, and any SOC reports that potentially are in place for your softwares or custodians that you're using there. And then finally, just some brief other considerations. So what controls should be in place for a non-custodian wallet? So looking at potential, as I said, the two-factor authentications, avoiding public Wi-Fi's when you're logging into your wallets, and implementing transaction controls, so multi-signatures or restrictions on trade on a daily basis. Looking to reconcile between your wallets and your accounting system on a periodic basis. That's if you're not using something like a portfolio software on that third point. So something like a Coinly, a coin tracker, coin tracking, they link directly into your crypto wallets, record every single transaction, and that can then be exported into your accounting software there as well. And then finally, just making sure that you keep a track of the accounting value versus the historical tax value for your regulatory reporting requirements there as well. But also that also is incorporated within the portfolio software if you are adopting one of those. I'll just hand back to Joseph Archer just to close off the webinar and open up for a Q&A.
Thank you, Nick, and thank you, Callum, Phil, and Jessica. I kind of appreciate the time. I know we're literally bang on 10, so I'm going to leave questions. We have had some in the chat, and so what we will do on those, we'll just make sure we kind of send responses to the relevant people accordingly. But thank you very much, everybody, for your time and for listening. And obviously, if anyone has any further questions they want to do, please don't ever hesitate to reach out to us. All the best, and thanks once again.